and welcome to episode 33 of Takeaways. My name is Patrick Searcy. I'm Director of Marketing for ALN Apartment Data, and I'm joined by the actual star of the show here, Senior Market Analyst, Jordan Brooks. Jordan, how are you today?
I'm doing great, Patrick. How about you?
I'm doing excellent. I'm looking forward to next week is the Texas Apartment Association's One Conference and Expo, and you'll be speaking. We'll get to see each other in person. I'm sure we'll talk more about that here in just a little bit, but let's talk about your article for the month. It's raining new units in multifamily. Now you mentioned national occupancy change in the first quarter. Was that issue more low demand or a lot of new supply?
Well, it was certainly a combination of the two. Nationally, multifamily demand was significantly lower than is typical for the first quarter. Simultaneously, new supply was significantly higher than has been typical in recent years, and so those two things sort of conspired together to see what we saw on the occupancy front, which was a pretty significant decline. I would say at the market level, those markets that were able to actually add to average occupancy in the first quarter, for the most part, were smaller markets that really didn't see much, if any, new supply in the quarter. Whereas if you look at the markets that really lost the most ground on the occupancy front in the first 3 months of the year, it tended to be areas that lagged in demand, but also did have a fair bit of new supply. And so I think, moving forward through the rest of 2023, new supply is certainly going to be something to watch, probably even more so than in a typical year, just because we're anticipating a very active construction pipeline this year. And until or if demand finally picks up, there's going to be a pretty large gap between new units coming online and units absorbed in a lot of these markets.
So you talked about a handful of markets on each end of the rent change spectrum for the quarter. What was the overall distribution like in the market level results?
I would say there was a slight positive skew in that if you kind of tranche markets into baskets of rent change, really the top two groups were both positive. They were just slightly positive. So I think, if memory serves, a little over half of national markets saw rent change go from basically no gain to about 1.7%, which, so again, more than half of markets sort of in that range. But for markets outside of that range, there was a little bit of negative skew. So in terms of large categories, you're talking about a pretty good number of markets that saw rents decline by 1% to 1.5%. So overall, I would say we did see, certainly at the national level, rent growth was basically flat. At the market level, there was some variance there, obviously. And again, slightly majority of markets were kind of in low positive territory.
The final sentence of your article was, as the calendar moves toward mid-year, inflation, employment, and the balance between net absorbed units and new units delivered will be very much worthy of focus. Can you unpack that for us a little bit?
Sure. As I kind of briefly touched on a second ago, this year we're really anticipating a very active year for multifamily deliveries. Multifamily demand has been low since about the middle of the year last year. Most markets really kind of fell off in July or August. And in the first quarter, we saw that trend kind of continue. March, nationally, we did at least see some positive absorption, but the quarterly number was much lower even than last year's. And we had started to see a cool off already in the first quarter of last year. So, we're anticipating, kind of with the macroeconomic headwinds that the industry is operating in, absorption is going to be a bit low this year. Given that we're going to see a lot of new supply, that's obviously then going to further pressure occupancies. And I think one of the main drivers when we talk about macroeconomic headwinds is going to be sort of the Fed policy around inflation. We've seen pretty aggressive policy so far. Inflation's been fairly stubborn, but we got some good news here recently in that the rate of growth at least has ticked down further. And that progress has been managed without seeing a huge softening in the labor market. Obviously, we've seen cracks emerge, as I mentioned in the newsletter. But if you look at just the overall labor force participation rate, the size of the labor force, the unemployment rate, we've not seen a material sort of degradation in that situation yet, even with the Fed policy that has been, fairly aggressive. And so if that can continue, if we can get some improvement, further improvement on the inflation problem without really seeing a heavy softening of the labor market, then that's going to bode better for multifamily demand. But if to really rein in inflation, we see unemployment go from 3.5 to 4, 4.5, 5, 5.5%. That's when we're factoring in the units that we know are going to come online this year with what might apartment demand look like. That's when things get a bit rockier, if you will.
Well, we talked a little bit already about Texas Apartment Association is coming up. When we're recording this, it's next week. So that's coming up. You'll be speaking there. Talk to us about what you have on your calendar.
Right. So in addition to TAA next week, I'll be speaking at the Apartment Association of North Carolina, their annual conference and trade show on April 26th. I will then be speaking at the South Carolina Apartment Association on May 16th. That's going to be in Columbia. May 17th, I'll be back in Tampa speaking at the Bay Area Apartment Association's regional roundtable event. And then May 23rd, I'll be speaking at ResMania back in our stomping grounds in Dallas. And then finally, I'll be wrapping up May 31st doing a webinar for the Apartment Association of Greater Los Angeles. And so, for any of those events, if those areas are relevant to viewers of this, we'll have lots of information on our social media. And then, of course, I always like to plug our blog, alndata.com/blog. As time allows, we'll have some great content going up there as well in the coming weeks.
Well, I do look forward to seeing you. Keep an eye on our social media for more info. You can follow us on Twitter at ALN APT Data, or just search for ALN Apartment Data on Facebook, LinkedIn, and Instagram. Don't forget to hit that like and subscribe button. Click that notification bell. That way you don't ever miss any of our new content as we put it out. Jordan, thank you so much again for another month of takeaways. Really appreciate it and I look forward to seeing you next month.
Thanks, Patrick. See you soon.